Welcome back everybody to another video. So in today's video, I'm going to be discussing with you guys the top 5 reasons why I see day traders failing. Now, over the last 7 years of my day trading career, I have had the honor and the opportunity to work and help hundreds of day traders with their own careers, not just myself. So I've been able to pick up and really gather a ton of data as to why the majority of traders are failing. And I've decided to compile the top 5 reasons as to why I see day traders aren't profitable in the long run, and just put it all into one video for you guys to learn from not just their mistakes, but from my own mistakes as well, because I've done a lot of these same mistakes as a rookie trader. So getting right into the video, the number 1 reason why I see the majority of traders struggling or failing is because they don't have a trading plan or they don't have a trading structure. When we talk about consistency in the markets, I'm not necessarily meaning a consistent P&L, but what I talk about is having a consistent approach to the markets. Trading is a business, and if you want to make big money in the markets or even just make a return on investment from the markets alone, then you have to treat it as such. So to give you guys a rough example, the majority of traders really don't have a trading plan or a trading structure. What I see a lot of traders doing is they're just actively trading and looking at their P&L as their trading journal, and that's not necessarily the case on how you should be treating your business, because that's not the appropriate way to actually keep track of your P&L, because you're not going into deep statistics. So to give you guys the example of how you could set up your own trading journal and start structuring your trading business is, for me, I like to trade futures and indices during the New York session. So you want to have a pre-market analysis time, you want to have an active trading time, then you want to have a post-market analysis time. Just because the majority of markets are open 24/5 doesn't necessarily mean you want to trade them 24/5. You only want to trade them during high times of volatility and volume. So to give you guys the example of my pre-market, post-market, and my active trading times is the market opens up at 9:30, so I'm actively performing my pre-market analysis at 8:50 a.m. all the way to about 9:30, which is the market open. Now I'm actively trading and looking for positions in between 9:30 a.m. all the way to roughly around 11:30 to 12 p.m. and this is all Eastern Standard Time. And then at 7 p.m. is when I perform my post-market analysis, and I follow that routine consistently Monday through Friday. Now, not only do you need to have your pre-market, post-market analysis and active trading times listed in your trading structure and trading plan, you also need to list off what instruments you're going to be trading. So for me, I'm going to be trading ES and Q, or SPX and NAS 100. Those are really the only 2 instruments that I actually trade. Not just that, you're also going to want to list off what type of capital you're going to be using in your trading plan as well, and what type of risk you're going to be taking with that capital. So for the majority of people, let's just call it, you're going to have $10,000 into a trading account. Typically what you'll see, the majority of people, you should be risking around 1 or 2% per position. And then on top of that, if you're going to be trading prop, you want to build a trading plan around trading prop. So let's just say you want to have a trading structure of prop firm A, B, C, and D. Those are going to be your main prop firms. With prop firm A, you're going to have X amount of capital, or that's the capital allocation you want to go for. And you're going to follow the same plan with prop firm B, C, and D. So you want to have literally everything listed inside of your trading plan, because your trading plan is very similar to a business plan. So when somebody opens up a traditional business and you're going to go get a business loan, or you're looking for investors to fund your business, you're not just going to go to them and talk to them just simply about the business and why you think the business is going to work out. You're going to show them a drafted and finalized business plan so you can receive that funding. And trading should be the same exact thing. Before you even start trading, you want to have everything planned out on how you're actually going to execute. And then inside of your trading journal as well, you also want to have your playbook, which essentially is the list of strategies that you're going to be trading and how you're going to be trading those strategies. And then within inside of your playbook and your journal, you also want to have your pre-market journal and your post-market journal. So in your pre-market journal, what you're going to want to be listing off essentially is what price action did overnight and what you possibly could see price action doing moving into the trading session. And then you're also going to have a plan of attack and what playbook setups you're going to be looking to take on that specific day through an if and then thought process based off of what price action could potentially do. So to give you guys this example, if you see price action on a higher time frame, this is me journaling. If you see price action on a higher time frame trending bullish on the 4-hour time frame, on the daily time frame, and on the hour time frame, and your game plan is to wait for a pullback back down into a certain key level where you're going to be looking to take a bounce play, and those are all things you want to put in your pre-market journal. Now, during your active trading time, you also want to list off the reasons why you're looking to take that specific trade and what could potentially be changing. So that way in your post-market journal, when you're done actually trading, you can look back to see if you followed the pre-market journal plan. And if you did, then that's a significant sign that you are actually on a right track, because you're following your trading plan on a consistent basis, and you're only going to be building good habits moving into the near future. Now, the second biggest reason why I see the majority of traders failing is because they are simply over leveraging and over trading within the same day. You'll be surprised on how many traders, doesn't matter if they're swing traders, day traders, or scalpers, are taking 8, 9, 10, 13, 14, even up to 20 trades a day. This is something that I struggled with very early on in the beginning and didn't recognize this as over trading and over leveraging, because I just saw it as trading. Typically what happens, and I know the majority of you guys are going to relate, is you start off the trading day really excited to get into the market to potentially make some money. You end up taking a loss or two, thinking to yourself like, oh, I don't want to kind of go out and move out on a loss and end the day on a loss. You know what? I'm just going to take one more trade. And that trade ends up becoming a loss. And you're like, you know what? I'm going to stick around, maybe see if I can make those 3 losses back. And you start to spiral out of control, and you start to overtrade and you start to over leverage. Some people will just keep adding positions to a losing trade. Other people will just slowly paper cut their trading accounts, and it's literally death by 1,000 cuts. Or other people will just end up holding one huge position, leading to a stop loss. This is going back to number 1, which is structure and trading plan. If you have in your structure and your trading plan, hey, you know what? I'm a day trader. I only want to take 1 or 2 trades on a single day. You need to follow that consistently. So one good guideline that I like to personally follow is typically when my first trade of the day is green, I'm pretty much done for that specific day. It doesn't really matter if it's a large green trade or a small green trade. On average, I'm done for that day, although I allow myself 1 to 3 trades on a specific day. Some of you guys who are really struggling with over trading, I highly recommend you just take 1 trade a day. Doesn't matter if it's a break even, if it's a loss, or you entered the position on mistake and close it really quick. 1 trade a day is all you want to see in your trading journal. For those of you guys who may not struggle with over trading so much, but you actually do have a tendency to overtrade a little bit, you could be a little bit more lenient and maybe take 1 or 2 positions on that specific day. And for those of you who you guys have feel like you've really gotten out of that over trading and over leveraging phase, then you can start to focus on maybe 1 to 3 trades a day. So for me, I like to focus on 1 to 3 trades a day, because I know I have the discipline to stop myself after that 3rd trade, especially if I have 2 losses in the morning. Typically, if I have 1 loss in the morning, then I would look for another position to potentially make that loss back plus more if opportunity presents itself. But if opportunity doesn't present itself, then I'm going to call it a day there. Sometimes I will make that loss back plus more. Sometimes I'll take a 2nd loss, which is a controlled loss, and then I'll call it a day then and there. Now, moving on to number 3, emotional trading. A huge reason as to why a lot of day traders are failing is because they are consistently hurting their P&L by making emotional decisions in the market. Typically, what you're going to see a lot of the time is this is caused by FOMO and greed, because you're just focused on making money and not actually placing good trades. And one thing that I wanted to discuss with you guys as well is, even if you're not making decisions out of emotion, you're not thinking critically as well when it comes to a lot of these different trades. So we really want to analyze these trades and verify that they really are a high probability setup. And then even if you have already verified that that trade is a high probability setup and there really is a great chance or a great probability for price action to go in your favor for you to capitalize off of, you really have to ask yourself if that trade is worth taking that specific risk. There is a lot of days where I do find myself in situations where there is a really great setup presented to me and I just decide not to take the trade because the trade just simply wasn't worth the risk based off the R multiple. There's a lot of times where it's like, yeah, you know what, this is an A++ setup, but I'm only really going to gain like a 2R multiple out of this trade. It's not really worth taking. I want to try and get into positions that I'm going to be taking a 3 or 4 or 5 R multiple out of the trade. And I don't just enter that trade based off emotions because I want to make quick money. Just because I'm going to make a 2R multiple, while although yes, it's positive, it's not something I want to strive for every single day just for a 2R multiple. I want to strive for a 3, 4, 5R multiple on a daily basis if possible, but I wouldn't mind if maybe a trailing stop loss gets hit at a 2R multiple, or I end up closing the trade at a 2R multiple because the probabilities just significantly changed and I started getting a lot of signals that we could potentially see a big reversal in the markets, and then that's a completely different situation. So a lot of traders will tend to trade out of emotions and not think out of logic and actually have critical thinking when taking a lot of these trades. So I want you guys to really think about every single position that you're going to place on that market and every single position that you're going to place on that trading account, and really ask yourself after you've identified if that trade is a high probability trade, if that trade is still worth taking. And I like to base that off of the potential R multiple that I'm going to get out of that specific trade. If it's a 3, 4, 5 hour multiple, then I'll say, yes, you know what, this trade is worth taking. Or if it's a 1.8, 2 hour multiple, maybe even a 2.3 hour multiple, even a 2.5 hour multiple, I may think to myself, hey, you know what, this position may not be worth taking. I'll just sit on my hands and wait for the next opportunity. What I also see a lot happening as well is a lot of traders will actually just take these random breakout trades because they see a ton of volume come into the markets out of nowhere, take that position and price action come all the way back, and it was just a simple liquidity grab, or the buyers or the sellers in that situation simply got absorbed and you see price action moving in the opposite direction. You really have to remove emotion from your trading as much as you possibly can. And honestly, the easiest way to do this is really just by lowering your position size to the point where you don't really even care about the P&L in your specific trading account. Doesn't matter if you're trading funded, doesn't matter if you're trading personal capital. Once you get to the point where you're not really too emotional, you don't really care about the P&L swings in your trading account, and that's when you know that's like a good position size for you to start off trading. Now, typically, as you progress and excel as a trader, you're always going to struggle with this topic, which is emotional trading, but it'll be easier to deal with and manage as time progresses because you're going to be a more experienced and veteran trader. Now, another topic that I wanted to discuss with you guys, number 4, as to why I see the majority of traders not making money consistently, it's just simply because they're not taking quality trades. So they're not taking high probability setups. When I talk to a lot of traders and ask them if they have a simple playbook or at least something structurized as to what they're naming their setups where they could see the performance of that specific setup, they don't even know what a playbook actually is. So once I actually built my playbook years ago, that was the rough draft for me to start constantly refining my system and my strategy. So for me, I'm a discretionary trader, and what I mean by that is I trade based off of what price action is telling me in the price action data along with the order flow data. Once I've interpreted that data, I then look for potential setups within my playbook that I could take based off of that data. And the majority of traders don't have something as simple as a playbook. Now, why a playbook is so important is because I have a name for my specific setups along with rules for the entries, the exits, and the trade management as well. So then when I go back into my journal in the post-market review and I list off the reasons why I ended up taking that position and really just going over my journal, I can really see what setups are performing the best and in what market conditions. I could see the win rates of these specific setups within inside of my playbook, and I could see what areas of that specific setup need to be refined. And that is super important to do as a day trader. You need to constantly be refining and improving your trading system and your trading setups, which is why a lot of these traders who really don't have a playbook are really taking these random low quality trades because they're just not focused on high probability setups. Now, the setups that you're going to find and list in your playbook are, of course, going to be a high probability setup, but you still need to combine what you see in your playbook with what price action is actually telling you. It's not necessarily taking every single setup or every single play that you see in your playbook, but it's really combining what price action is telling you, performing your top-down analysis, looking for these plays inside of your playbook at key levels, which will really formulate a high probability setup. And I do not see the majority of traders actually doing that on a day-to-day basis. And then again, how are you going to have a consistent approach to the markets if you don't even have a playbook where you can consistently follow a setup on a day-to-day basis? And even if you guys are trading a setup that is so black and white, because my playbook isn't necessarily very black and white, but it is a list of plays that I do take on a daily basis. And I do look for my playbook setups along with my higher time frame analysis, my lower time frame analysis, and my key levels. And that's what allows me to approach the markets every single day on a consistent basis. And last but not least, one of the biggest reasons as to why I see the majority of day traders failing is just really setting unrealistic expectations. I've talked to a lot of day traders who've only been trading for a few months thinking that they're going to turn a few $100 into hundreds or if not millions of dollars, which it is honestly truly a blessing that the prop firm space is up and running nowadays, because you have a lot of opportunity that you guys could be taking advantage of. And what I tell people is like, look, to be honest with you, if you're going to deposit $1,000 into a trading account, just trade that $1,000 with a 1 to 2% risk. I know you're not going to be making any money, but what you're going to be doing is you're going to start building confidence out of your trading system and in your trading system, and you're also going to be able to experience the markets live. And once you see that you have a nice solid track record of at least 2 to 3 months where you've been able to actually not just break even, but at least make an ROI on your trading account, then go for a free trial, test it out, see how you like it, because the swings in P&L of course are going to be very different. And then on top of that, if you start seeing that, you know what, you've passed the free trial after you've already made money on a live account, then why not try a prop account? You know, that same $1,000 should get you a $200,000 funded account. And just imagine making 10% in a single month on $200,000. You know, you get to keep 80 or 90% of those profits, which is truly amazing because you were able to leverage just simply $1,000 and you're able to realistically turn that $1,000 into 20 grand by just literally leveraging your knowledge, versus the probability of you turning $1,000 of life capital into $20,000 in a real live market condition. It's going to be very difficult for you to actually do. The probability of success by over leveraging your $1,000 account to turn it into 20 grand is very low. Again, it's possible, but it is very low. I've seen people do it before, but that's not the right mindset that you want to instill in yourself, because that type of trading is not sustainable and it's unrealistic to expect returns like that from the markets every single month. My biggest thing for you guys is don't expect to turn a few $100 or a few $1,000s into millions of dollars, especially in a very short time frame. That is something that is going to take a lot of time to do, and the probability of success in terms of turning a few $100 or a few $1,000s into hundreds of thousands, if not millions of dollars, is going to be very low. Again, it's possible, but that's not the mindset that you want to actually instill in yourself. The mindset that I would recommend you guys do is, okay, well, you know what? How much money could I really make on a monthly basis if I just strive and shoot for 10% a month? Then on 600K, I can make $60,000. On $1 million, I can make $100,000. So then the real game plan is, okay, well, if you want to leverage prop, how can you use all of these prop firms to your advantage to get that $1 million trading portfolio, where you have a portfolio that's diversified in between all these different prop firms, and your goal is to simply make 10% a month. And if you incorporate and build a trading plan based off of that, you're really going to set yourself up for success in the long run. Anyways, guys, I hope you guys did actually enjoy this video. Before this video does end, what I did want to let you guys know is one of my students just recently bought an R8, which is an amazing accomplishment. You guys can see it here. And I recently did go through my archives and look for a podcast that I did with him 2 years ago, because he's been a student with me for roughly around 3 or 4 years now. And I did a podcast with him breaking down essentially how he became a $1.7 million funded trader in between multiple different portfolios, and how he started to actually make money in the markets. So if you guys want to see that podcast, and make sure you guys just click the first link down in the description, you'll be able to see Jeff's story from how he started trading all the way to becoming a $1.7 million funded trader to now buying his dream car, which I think is a super inspirational story. Other than that, guys, make sure you guys like, comment, subscribe, and I'll see you guys in the next video.